Good. Welcome back. So sorry about the catch. So kindly watch the part one of the inventory before you continue from the part two. Good. It was a little distraction, so sorry about that. Now let's continue. Now, accrual concept requires revenue and its related cost expense must be matched. So as a result of this, inventory is what? An asset. Sorry, inventory is what? An expense. So inventory, that's what you record in the cost of sales. So the open inventory that you see in the cost of sales is an expense which form part of the cost of sales. So that is it. It must be matched against its what related revenue. That's the simplest word definition. Then at some point in time, inventory is what? An asset according to the same concept, accrual concept. At what point in time inventory can be what? Asset. That's why you can see inventory on the financial position and then what? On the face of what? P&L too. You can also see that. Now, unsold inventory or unsold goods. Unsold inventory. Unsold what? Inventory. Unsold inventory. It means that it does not have related revenue. Good. The thing is like this. Whatever you earn, match it against whatever you spend to determine the profit. That's the accrual or matching concept. So the unsold inventory, then we cannot add it to our cost for this year. Why? Because there's no related revenue. So that inventory that is left over, we have not made any sale. So what do? Then let's carry it forward. So unsold inventory must be what? Must be carried forward. Must be carried forward so that when we sell it, then next year when we sell it, then we can match it in a P&L. So that's why inventory at a point in time it become what? An asset. And at a certain point in time it's what? An expense. So take note of this. Now, you carry it forward and record it what? On the balance sheet. Don't forget that the balance sheet or the financial position takes only balances. It does not take consumption. What you consume for the year, no. What you consume for the year will go to what? Will go to the profit and loss, the P&L. That's what we call it balance. So a sheet that will record all the balances on. How we get it? So now we call it what? Financial position. So profit or loss, that one is the consumption. What you've consumed and what you've earned. And the balances. Sometimes there are some of the balances, some of the assets have balances and the liabilities, then bring them to the balance sheet. So that's the main issue about inventory. So now you know that at a point in time, inventory can be what? Assets. At a point in time, inventory can be what? Expense. So here when it means that unsold inventory, that's closing inventory, unsold inventory, they are what? Asset. But sold inventory, the cost of sold inventory are what? Expense. The cost of what? Sold inventory. Good. They are what? They are expense. So that's why it's the open inventory plus what? Purchases less closing inventory. Why? Because this is sold, this is unsold. So we have to take it off so that we carry it forward to the next period. I'm done and you are fine. Now let's look at we are done with the recognition criteria. So with the recognition criteria of inventory, inventories are what? Assets if they are what? Unsold. Inventories are recorded as an expense if they are what? Sold. That's all. Okay. Yes. So sold inventories are what? Expense, and unsold inventories are what? Assets. Good news. Now let's go to the measurement. In fact, if you don't understand anything, not what I'm going to do. Measurement. What are the measurement base of inventory? So measurement basis. Now, when you talk about measurement, we are just asking how do you get a value of that item? So measurement simply means value. How we are going to what? Drive what? The value of that item. Good. So measurement of inventory. Now, the issue is that, good, inventory must be what? Valued, both initially and subsequently. So this gives us, or this gives rise to what? Two measurement bases. So we have what we call initial measurement. So initial measurement of inventory. You should know that. So initial measurement of inventory. Now, initially, inventory must be measured at what? At cost. Please, at what? Cost. So initially, inventory must be measured at what? At cost. Meaning the cost of what? The inventory. What's the meaning of initial measurement? If you go and buy, or if you acquired inventory today, the first time you acquire the inventory, how do you measure the inventory? How do you get a value of it? That's it. That's the initial measurement. So initially, inventory must be measured at cost. What's the cost? We are talking about what? Cash and cash equivalent transferred to acquire the goods. So now, let's look at the composition of the cost. Now, it includes some cost and it excludes some cost. So let's look at the inclusion. So inclusion of cost of inventory. So initial inventory must be measured at what? At cost. How much what you acquire. Okay. So inclusion. Now, the cost of inventory must comprise of 3 items. Assuming that you went to the markets to acquire some bags of rice. Initially, maybe you buy and sell rice. So you go in and offload 5,000 bags of rice from the supplier. These 5,000 bags of rice, maybe at 100 Ghana cedis, that will be what? 50,000 cedis. So value at 50,000 cedis. Now you pay the supplier 50,000 cedis. So the question is, how are you going to measure this inventory? How are you going to what? Measure this inventory initially? So the first day you brought these 5,000 bags of rice into your shop or your warehouse, what will be the value are you going to place on it? Abigail. So that's the initial measurement. Initial what? Measurement of inventory. Good. So let's we are saying that it must be measured at cost. Let me do that one here, and then you will be fine. Let me do that one here, and then you will be fine. I think I'll do it at the very nice place for you, so that you will be what? Fine. Good. Now let's see. I'll do on top so that I get enough space. So initially, inventory must be measured at what? At cost. So what is the composition of cost of inventory? So inventory comprises of, or the inclusion of cost. So that means you will get a lot of cost, because bringing 5,000 bags of rice, 5,000 bags of rice to your warehouse, you are not going to incur just the purchasing cost. It includes a lot of cost. But Not all of them you are going to include it as cost of what? Inventory. Not all of them you are going to include as what? Cost of inventory. So now let's see the composition. First, the purchase price. So how much you bought the goods? So one, the purchase price. You comprise of one, three items. So purchase what? Price. How much you bought what? The goods or the purchase cost. Let's make it purchase cost. I like the cost more than what? The price. The purchase cost. But the purchase cost include the purchase price itself. So purchase cost include what? The purchase price itself. So this includes what? Purchase what? Price. Comma. What again? Delivery. Delivery or the transportation or handling cost. So delivery, handling cost, handling cost. Then what again? Tell us handling cost. Handling cost. Import duties. Import duties. But many. And then I like this one. Irrecoverable purchase taxes. Irrecoverable purchase what? Taxes. So irrecoverable purchase taxes. Irrecoverable purchase taxes. Purchase taxes. In short, any tax that you pay on these goods, it must be part of what? The purchase cost. If and only if you cannot what? Recover. So the tax that you are going to recover should not be part of it. But the tax that you are not going to recover, some of the tax you can recover them. Example, the input taxes or the VAT that you paid on them. Critical example is the VAT. If we are VAT registered entity, all the VATs that you pay on your raw materials or your inputs or the goods, you can claim them back. So that it must not include it. However, if you pay any tax, any VAT, that you know that this VAT, I cannot claim this tax back, then that one must be what? Part. So irrecoverable purchase taxes, taxes that cannot be recovered. You paid it, but you can't recover them. So that is it. Let's what? Let's trade discount or similar rebates. Not rebate. So the question is, what is rebate? Similar word, rebate. What is rebate? What is rebate? Good. Now, trade discounts. Now, discounts are reduction in price for two reasons. Either you are buying more or you are paying on time. So the trade discount is also called what? Settlement discount. So anytime you acquire goods and then like you buy bulk, so any bulk discount, buy 3 and get 1 free. So you buy 3. In fact, it means that you bought 4, but you pay for 3. 1 was for free. So you less all the trade discount. Please, you are saying trade discount. You didn't say cash discount. Now, cash discounts are discount that you give on what? Prompt settlement. Now let me do this. We are saying discount. Simple means reduction in what? Price. That is what? Discount. So we are going to reduce the price due to one for 2 reasons. So there are 2 types. So for bulk purchases or for prompt settlement, prompt payment. So these are the two reasons. Now the bulk one is called trade discount, and that's what we want. Prompt payment. If you pay on time, we can reduce the price for you. That one is cash discount or supplement discount. That one goes to the profit and loss. That one does not come here. So we should take note. Or similar rebate. Rebates are tax reduction. You know that sometimes some of the materials, especially educational materials and what health material, there are rebates on them. You don't pay the full tax. So this one alone is what is under purchase what cost. But there are three of these ones. So let's look at the other ones. Good. Now the second cost that when you incur, you have to include it, add it to it. Two is the conversion word cost. So is the conversion. So conversion cost. These are the directly attributable labor and overhead cost. Labor and what? Overhead. Overhead cost. No shortcut allow. But let me write them for down there. Attributable what? Labor and overhead cost. Good. Now we are saying, in fact, conversion costs as learning management accounting are the cost that you incur when you convert the raw material that you purchase into finished goods. So that's the production cost. Directly attributable production cost, which include what? The direct labor and direct what? Overheads, like directly attributable. Now these overheads, once they are production what? Overheads, both variable and what? Fixed. I repeat, both what? Variable and what? Fixed. The overheads, both what? Variable plus what? Fixed. I'm not saying only the variable one. So fixed production overhead must also form part of the cost of the event. So that is it. Now, let me give a practical example. Let's assume that the rice that we bought, we normally sell the rice in what? Small quantities. So we break the sack and then normally we sell it in what? Olonka or margarine. Now, directly attributable cost would be something like we need to engage the service of people to be breaking the sacks for us. Because 5,000 bags of rice, you can't do it alone. No. And then we have to be pouring it small. And these people will charge us. So that's directly labor cost. And then what about the overheads? You have to go and buy margin rubber, get a warehouse, rent, all of this. You have to also get what? Electricity. Probably sometime you can do some of the work night. You have to also get security, supervisors. Now, all these are what the overhead would cost, but it must be directly attributable to the rice. If your general operations, admin costs not form parts, that's not what you're talking about here. Admin overheads should not be here. So that's the directly. If you were a manufacturing company, then you will buy what? Raw materials. You will be the raw materials, and this one will be the production cost. What? Production cost. Good. And the last one or the third one is what? Any other cost. Any other cost. So the third one is what? Any what? Other cost incurred necessary to bring the asset to its what? Present condition or location. So any other cost incurred necessary to bring the asset. Here you can write the inventory. Inventory to what? It present condition. We normally say and location. Present condition and what? Location. And location. Good. So that is the other cost. So any other cost that you incur, necessary, necessary to bring the asset to its what? Present condition or location. Now, example, let's assume that we sell water. We sell what? Water. Sachet water. So it can be bottle or sachet water. Once drinkable one. Now, we cannot put these sachet water or the boxes on the bare floor. So you have to mount a structure called the pillets or the pallets. Then you have to put the sachet water on it so that the scents or we won't taste or the water will not taste what different from its original taste, or there will not be any little mouth or smell in the water coming from what? The floor. Such cost is called, that's the other cost, because that's no production cost, that's no purchase cost. How do you get it? So that's any other cost that you incur. That's good. So now these are, so in the exams, when they ask you to calculate the cost of a certain inventory, the examiner just asking you to bring these issues down. There are three. Basically, there are what? Three. So basically, there are three. So purchase cost, conversion cost, and any other cost. So these are the three. Any what? Other cost. So finally, so any other cost. So these are the three costs that should be what? In the cost of what? Inventory. Now that we have inclusion, we also have what? Exclusion. So this is inclusion. This one have to add it. Exclusion, you have to exclude it. Please, exclusion does not mean go and subtract. No, don't even touch it. That's what you're talking about. So exclusion. Good. So exclusion from where? From the cost of the inventory. So exclusion from the cost of inventory. Now, all the following costs must be what? Excluded from the cost of the inventory. All the following costs must be excluded. Excluded means do not touch it. So if I put some costs here and I say exclude it, that means do not touch it. Add all the inclusion and just leave what? The exclusion out. Don't even touch it at all. Exclusion does not mean go and subtract it from the cost of the event. No. But the issue is that if the examiner or the company have done it wrong by adding it, what do? We subtract it because you're supposed not to touch it at all. Good. One, administrative overheads. So administrative overheads. No shortcut in the exam. Two, I can add general and administrative overheads. Let me make it so that I will not write general again. So general and what? Admin overheads. Two, selling and distribution cost. Selling and what? Distribution cost. Then the three, or the third one, storage cost of the finished goods. So storage cost of what? The finished goods. So of the finished goods. Good. So that's the storage cost of the finished goods. This cost, when you incur them, don't touch it. Don't do don't do what? Touch it. So that is it. Don't touch it. So that is the concept. That is the concept of the inventory. So in essence, you see them mixing it. So we can give you like 3 inclusion and then 3 exclusion and actually calculate the cost of the event. So I'll walk you through few of them. I'll walk you through what? Few of them. Then I'll go to the subsequent measurements. Now let's walk through few of the inventory. So now let's go to the handout. Kindly, if you don't have it, request and it will be delivered to you. Good. So I'll pick my first illustration. The first illustration, but the first illustration. But before I do that, let me add one item to this that recently came in mind. That's the abnormal wastage or initial losses. Abnormal, right? Normal wastage. Abnormal wastage. What do you mean by abnormal wastage? Abnormal wastage occur or abnormal waste. It's okay when some of the inventory is being what lost. So the 5,000 bags of rice. Let's assume that accidentally, when they were breaking the sacks, one of them fell down. After they've loosed the sack, it fell down and accidentally the full bag of rice poured on the floor. And unfortunately for us, our warehouse too, we've done in such a way that the grounds are full of what? Particles, which mix with what? With the rice, turning the rice or making it what? Non-edible. So eventually what? Wasted a full bag of rice. Don't tell yourself that, I suppose you have a profit of 100 Ghana cedis on that bag of rice. So let me add it to the cost of what? The goods. No, we do double counting. So the abnormal waste or the abnormal loss, I also call it what? Abnormal loss. Abnormal loss on the inventory must be recorded in where? In the profit and loss as an expense, but it should not be capitalized or add to the cost of what? The inventory. How we get it? Normal loss, you know that for sure, like 1 or 2 cups of rice probably will fall down, maybe 1 or 2 probably fall down. But a full bag of rice, throwing it away, that becomes what? Abnormal. So some of the loss are normal. Yes. I mean, now when you are sewing, the cloth is in rectangular shape or square shape, you cut some edges and throw it away. That one is normal. That's normal loss. But sometimes in cutting, you end up cutting it too much. So now it becomes what? Abnormal. Normal cutting. So it will create abnormal loss. It will create a shortage in what? In the fabric. So that is it. So these are what the solution. Now let's continue the question. Then you'll be fine. So I'll solve the question 2. A Met company has a cost card in relation to an item of goods manufactured as follows. Materials, 70 Ghana cedis. Storage cost of what? Finished goods, that's 18 cedis. Delivery to customer, 4 Ghana cedis. Irrecoverable purchase taxes. That's what 6 cities. According to IAS 2 inventories, at what figure should the item be valued? So when we see this, we are asking for the initial measurements. We said the initial measurements, it must comprise of what? The purchase cost. So initial measurement must be, the initial measurement of inventory must be at what cost? Initial inventory must be measured at what cost? Good. Then the cost comprised of what? 1, purchase what cost. 2, conversion cost, and lastly, any other cost. So material, that's a purchase cost. So they bought material, so that one have to be parts. So material costs have to be part of what the purchase cost. That's the material cost. What about storage cost of finished goods? No, because you see here, storage cost of finished goods must be excluded. Storage cost of what? Finished goods, this one. Anyway, it must be what? Excluded from the cost of what? Event. Now let's continue the game. Then delivery to customers, should it be part? Delivery. No, delivery to customers should not be part. That's selling and distribution cost. If we are going to deliver the goods to the customer, that's selling point. We are just looking at what? Obtaining the goods. How do you get the goods ready? So any cost that you incur up to the point when the goods are ready for sale. So that's why we make a point that when the goods are what? At their present condition or location. Condition that can be what? That can enable the intended use or sale. That is it. So that will be selling and distribution cost, which must be what? Excluded. So irrecoverable purchase tax, yes, it must be parts. It must be all parts. So in short, in solving this question, just add 70 to 60, 76, and then you are done. So this is how you will solve the question. The cost of the inventory, the cost of the inventory or the value of inventory. So we start with the material. Material cost was 70 cedis. Then we followed by what? Irrecoverable. Purchase taxes, it was 6 cedis. So we have 176. So that's the cost of the inventory. So the rest must be what? Excluded. So we are done. The rest must be excluded. And then you'll be fine. The rest must be excluded. Now let's continue the game. Example 2. SNAM company produces units of what? UB06. That's UB06. The following costs have been incurred. Direct material and labor. Should it form part? Yes, it must be part. But that's production cost. Variable production overhead. Should it be part? Variable production overhead. Yes, it must be part. Once there's what? Production. Once there's production, it must be part. Both variable and fixed production costs must be part. That's it. Factory administrative cost. No. Word dodge. Exclusion. Once there's what? Admin. Fixed production cost, it must be part. That means you add all except what? The factory administrative cost. So that's 1.8 plus 2.5. That's 2.02 plus 2. So 2.25. Good. So that's the cost. Now let's check if there's third one there. We try the third one. Our third question here is Woso. Yes. Woso company is a manufacturing company. The cost per unit of the item is shown on its cost card. Materials 30 must be part. Production cost 33. Should it be part? Yeah. Production labor cost. Yes, production labor. Once there's labor and there's what production. Especially where what is what production. Direct labor cost should form part. This cost must be directly attributable to that of that goods. Good. Production overheads, it must be part. So far we have 30, 33, and 12. General administrative cost or administration cost should be part. No admin and general, there should not be part. Marketing cost, not at all. That's selling distribution. So it's comprised of the first three. So 30 plus 33, 63 plus 12. That'll give us 75. That's the cost of the inventory. How we get it? Good. Now let's finish it up with a subsequent measurement and then you are fine. Now, subsequently, inventory. But if you don't understand anything, that's not what you are going to do. You have to understand every part of the subsequent measurement. So I write big. Subsequent word measurement. Let me write it down. Subsequent measurement. Now, subsequently, initial measurements, if you buy the inventory today, so let's assume that the first time you got the inventory, you can buy it at January. You can also buy it at when? February. Anytime at all. Can line when is that the first time initial measurement. Now, subsequent measurement means what's the next value, the next measurement, or the next reporting period, what will be the value? The next reporting period, and then the following, subsequent. So the subsequent measurement is, we also call it measurement after the initial recognition. Measurement afterwards, initial recognition. Measurement after the initial recognition. Now the issue is that the subsequent measurement just give us the value of the inventory. How inventory must be measured subsequently after first time, or even maybe let us assume that you bought some inventory around February. Your year starts at January. But you bought the goods at what February. You measure them at initial cost, that's good. Subsequently, the next reporting period, that's December. What will be the value I'm going to place in it? What will be the value I'm going to place on these goods so that we can key it in the financial statement? That's the year one, and then the first year. Second year, year two, December, what value are you going to place on these goods? So subsequent, how we get it right. So that's good. Now, if you don't understand anything in inventory, not the subsequent measurement, because here you give a rule. So the reason saying that subsequently, inventory must be measured at what? Inventory must be measured at the lower. At the lower of what? You compare two items and you choose what? The lowest one. At the lower of costs and what? Net realizable value. Net realizable value. How we get it? That's the NRV. So subsequently, compare and choose the lower of, you do something like this. So lower of cost of the asset, you compare and the NRV. So these two, cost of the inventory versus the NRV, and select what? The lowest one. Now let me talk about the cost of the inventory. How and what are the specific cost of inventory that we are talking about? Now let's see. Cost of what? Inventory. Cost of inventory. Cost of inventory. The cost of inventory. So I'll take them one after the other. What do we mean by the cost? Is it the same as the initial cost that we saw? Or the NRV? What does it mean by NRV? So now let's take the cost. The composition of the cost or the cost. IAS prescribe certain cost formulas. How do you get the cost? So IAS or the IAS to prescribe or outline some procedures or some method that we can use to arrive at what the cost of inventory, subsequent cost, not the initial cost. The initial cost already, the subsequent what cost. So we call it cost formulas. Cost what formula or the formulae or formulas. Now, one, you can use the actual cost. The actual cost, you know it already. The actual cost. That's what we did at the initial measurement. So the value of that inventory. Use that one. Two, you can use what we call FIFO, first in, first out method. Three, you can use what? Weighted average method or weighted average cost. Or you can also use the standard price. Please and please again, LIFO is being banned by what? IAS. So we don't use what? LIFO in estimating the cost of what? The goods. So find the closing inventory. For those of you who have done management accounting before or cost accounting, LIFO and FIFO was a very topical issue there, right? Good. But here, according to IAS 2, LIFO has been what? Banned. We don't use LIFO. However, if you go to the US GAAP, they have not banned LIFO. They still use what? LIFO. So have you seen the difference between what? I've given you what? One difference between the US GAAP and what? The IFRS. They still use what? LIFO in inventory valuation. But in IAS, you don't use what? LIFO. Good. So this is the cost formulas. The actual cost, which comprises of the three items that we saw: purchase cost, conversion, and any other cost. Or you can use FIFO, then you are done. Now this actual cost, for the student is saying that it must be specific. It must be what? Specific. So take note, it must be specific item. Now we are done with the cost. Let me go to the NRV. Net realizable value, NRV. And now we start solving question, then we are done. NRV. So net what? Net realizable value. Realizable value. In bracket what? NRV. So in bracket NRV. Now what is NRV? Or what is net realizable value? Net realizable means still, right? So if you sell the goods, how much are you going to recover? So this is the estimated amount to be recovered from an asset through or sale. So estimated amount, estimated what? Amount. So estimated is an estimate, not actual. I'll explain. So estimated amount, that will be recovered or that will be earned. So that will be recovered. Recovered from the inventory through what? Through sale. That is it. So through what? Sale. So if you sell these goods, it's an estimate. The word estimate is very important. Please, NRV is not actual, net realizable value. Here we are talking about estimates. It does not mean that you've actually published, sell the goods. So at the end of the reporting period, assess the NRV of your inventory, your goods. NRV simple means, if I should sell these goods today, If I should sell these goods, what I'm holding today or what I have today, how much will I recover? That does not mean that you've made what an actual sales. It's an estimate. Good. So that is it. So that's the explanation. Now let's look for the formula or the definition prescribed in the IAS. So an estimated amount to be realized or recovered or received from the sale of an asset is what the NRV. Asset was NRV. That is it. Now let's look at the definition or the formula for the one. Now you cannot define or explain NRV without the word estimate because it's not actual. So it says equal to estimated selling price, how much you sell the item, so selling price, comma, less what cost to complete the sale, cost to complete the sale, and cost to sell. Wow. And cost to sell. I'll explain these technical terms, and then as soon as I understand this, we are through with what IAS. Good. Now let's continue the game. Now, NRV simple means estimated selling price less estimated cost to complete. In fact, let me add the estimate. In fact, estimate must be attached to all of them. Estimate, because all of them are estimate. So estimated selling price less estimated cost to complete and less what estimated cost to sell. So the estimate must appear 3 times. One attached to the selling price, one attached to cost to complete. So that is it. Now let me put them in a nice formula for you. So we start estimated selling price so much less estimated cost to complete. That one is so much. Then estimated what cost to sell also so much. Then this is called NRV. This is very crucial. How do you get it? Now I'll take my time and explain each of the items. Selling price, you know, how much are going to sell the item, your normal selling price. And it will be net of what discount or any sales commission. Even though the discount and sales commission can appear again. Cost to complete, the confusion guy, cost to what? Complete the sale. Now, cost to complete is a cost that you have to incur before you can sell the goods. Let's assume that subsequently, let's assume that subsequently we are in 2000 and we bought some goods. January, we brought some rice. Last year, it's still in our inventory. That's the closing stock. We've tried as open stock this year. We've tried, we were not able to sell it. This year to the same thing. But we are estimating. Let's take the 5,000 bags of rice. Let's assume that 2 years, after 2 years, we still have some of the rice in store. And we are estimating the NRV of such rice. So you ask yourself, rice, which is 2 years old, how much will I sell it? Net of discount. Okay, I'll sell it for a bag. Maybe for a bag, I'll sell it for 80 Ghana cedis for a bag. come and pick it up. 8 years or so. For 2 years old. Then before I will sell this rice, cost to complete means the cost that you have to incur. We call it remedial work. Remedial. Petty expense that you have to incur before you can sell these goods. That is the word cost to complete. That's the cost to complete the sale. So example, the rice. You know that the sack, 2 year sack may not be strong as this. The sack in when the rice is in 2 years by now, or 2 years time, or we bought 2 years ago, or 2 years to come, the sack will be what? Old. We assume that we bought the rice 2 years what ago. The rice will be what? The sack will be what? Old. Now, when the sack is old, that means we cannot sell it in the old sack. If you let's assume that our rice is the local rice, that rice was a local rice. So we will go and buy Uncle Sam or Lily or Royal Aroma. We buy just the sack and then we pour our local rice in it and seal it as if it's what Lily or Uncle Sam. Yes, or Royal Aroma. Good. Now, those sacks that we have to go and buy to replace the torn or worn out sacks, their cost to what complete. Maybe each bag or the sack is what 5 Ghana cedis. So subtract 5 cedis. How we get it? Now, cost to sell. The item that I say you can subtract it from the selling price. Also, let's see. Cost to sell include what? Sales commission. Normally, you are going to sell it through what? Agents. Or the people that they will sell for you take what? Commission. So it includes what? Sales commission. Discount and any other selling cost. Maybe that one is also 10 Ghana cedis. So finally, you are getting what? 65 Ghana cedis as what? Your NRV. Please, this cost to complete, if not incurred it, is cost that yet to be incurred. You only incur that cost if you should sell the rice. We are estimating the NRV. Okay, what will be the value if we should sell the rice today? Okay, so if we should sell the rice today, then you will sell it for 80 Ghana cedis. But today you have to change the cover. Have you seen? Then before, and maybe selling cost 10 cedis. So this was the NRV. Please, the cost to complete normally conflicts or confuses students, especially they confused about this and then the convention cost. In fact, they are related or they are twins, just that all of them are heading towards different direction or opposite direction. Now, cost to complete is in future. If I should sell it, I have not incurred it. Convention cost I've incurred it. That's the difference. So I'll now put everything together for you. So now putting everything together, subsequently, inventory must be measured at the lower of the following and take note. This is how I want the format. The inventory must be measured at what? Lower of, maybe something like this. I'll put cost here. I'll put NRV here, no subtracting. So what is the composition of cost? 1, purchase cost. So much. That's if I use the actual method. You can also use the FIFO or the weighted average cost or the standard price. 2, conversion cost. Ghana cedis, so much, so much. Then 3, any other word cost, so much. So this will give us the total cost of the push. How we get it? Then we go to the other side. The other side will talk about what? the NRV, which is what? Estimated selling price. So estimated selling price. Now it will be so much. Less what? Estimated cost to complete. Less estimated cost to complete. So less what? Estimated cost to complete. And then what? Estimated cost to sell the goods. Estimated cost to what? Sell the goods. Estimated cost to sell the goods. So that is it. Now these items, so you compare this and choose what? The lower. That's all. So this is the summary. If you don't understand anything in inventory, not here, and then the fact is this summarizes everything about inventory. This is the initial measurement. So you compare and select what? The lowest. That is it. So I'll cite an example on the board, and then we start doing justice to the example. And then when we are done, we will look at some few issues and we are done with inventory. Please, the next video will be question solving, how to solve questions. This video was purposely for you to understand the issues in the standard, so that follow the next video and get all your practical questions solved and all your exam questions were solved. Good. Now let's see. Example. I'll give an example here. Or let's pick example from the handout. Let's see. Now let me explain this. In exams, the examiner may give you the total cost already. There's no need for you to worry yourself. Add all this note that's been given to you already. Or he can give to you individuals, so you sum it up, get a total cost. Or the NRV to the same thing. He can give you the breakdown or sum it up. The issue is that you being able to identify, please, when you are solving a question, you see how to identify the difference between these two. But they are very similar and they are like twins. Just that all these costs has been incurred to date. Incurred what? To date. That's the only difference between them. Incurred to date. All these costs, they've incurred them to date. So this cost it has been incurred. All these costs has been incurred. You've paid for it because, in fact, you've already converted it. You've already converted. In fact, if you put rice in a machine rubber for 2 years, in 2 years' time, but the rubber car will get done. So you have to change the rubber. So the conversion costs have been incurred already. You've converted it already to the small one. Good. Now, all these costs are not actual, they are estimates. These ones are estimates. They look into the future. Should I sell these goods? What will be the cost? If I should sell these goods, what will be what? The cost that I will incur. Not that I'm not done producing it. Let's assume that you are selling your phone. I'm selling this phone. And then you came and you informed me that you don't like the housing. So I should put a cover. I said, this phone do need a cover. Okay. Maybe you are telling me that you want a red cover. So I'm going to find a red cover and put it. That does not mean that the phone is not working. The phone is working. Everything is okay. Just that to suit your demand, to suit your preferences, have to make certain changes, add certain features to it. They are called what? Modification. The examiner may call it what? Modification cost. That is cost to complete. What if you are not going to buy the phone? I won't even do it. I'll wait. Different customer will come and tell me that I like different color or I like it like that. How we get it? So that is it. Now let's see example. Let me cite nice example here for us to be just please get it for me and then we will be fine. So example, I want to talk plenty. So watch how we will solve the questions. Example. At the end at the end of at the end of at the end of the reporting year, at the end of the reporting year, in fact, it's an extract I'm picking from some person. At the end of the reporting year, the inventory include the examiner, so you include some, that examiner says slow moving inventory, slow moving goods or damaged goods. Any of them, the examiner is one. Not a few. Damaged goods. You can also tell you damaged goods, which have a cost of 120,000 with a selling price or selling value, sold value or selling price, or which can be sold, so which can be sold for 155,000 cedis. 155,000 cedis. After a modification, cost of what? 10,500. Let me make it 10,500. And selling and a discount of 15%, or discount of I want to make this one 20,500. Okay, let me make this one 20,500. 20,000. No, 205. 20,500. Discount of 10%. Full stop. Required. Determine how this inventory will be stated. So the question will be like this, Esther. All what they give you, please try and extract the relevant ones. Where the figures are 1, 2, 3, 4. There are 4 figures. The rest you don't need it. So that is, so their cost is 120. So I'll just write their cost 120. I'm just summing the question. Sold for, the estimated selling price is 155. So we're supposed to just write the issues like this for you in exam so that you don't worry yourself. But when you do that, it's not an examination. You have already probably solved 10% of the question. So Ghana city was 155,000. Then there's what? Modification cost. So modification cost is what? 20,500. Then discount. Discount is 10%. That's all. But it means that the rest you can just name a question. Now, this is how it is. Any other information is what learn. They say the slow moving inventory must be measured at what lower of the cost. Yeah, it has been given to us. So given to be what 120,000. So now let's go to the NRV. NRV we have to talk about ourselves. So estimated selling price. The selling price is what 155,000. Then there's modification cost. So less modification cost. Modification cost. That's 20,500. Discount. Either you take it off from this figure or you can let it be on its own. So discount. Good. Now let's discount. So discount, say 10%. At 10% of this, right? That'll give us 15,500. Put in bracket. So therefore, what is the NRV? What is the cost? So cost is still 120,000. NRV what? NRV will be, so the NRV will be as putting 20,500 plus 15,500, so that's 36,000. So 36,000. 36,000. That's 155 minus 36,000. What would be the answer? So 155 plus 20.5 plus that's 15.52. Hey, what am I calculating? Getting something else that I go. 155 less what? Less 20.5 less 15.5 again. That's 119. Wow. 119,000. So which one? So therefore, look at what I want to write to. Therefore, this inventory must be measured at what? At the lower of these two. So comparing to the lowest one. I hope you can select the lowest one, right? Good. So this is the lowest one. So this is the term that we are going to use. So therefore, the inventory must be measured. Must be measured at what? At Ghana 119 2,000. Why? Because it is what? The lower. As the first point. Inventory must be measured at what? Or valued. Inventory must be measured or valued at what? At this figure. And finally, or second, can say that inventory must be written down to the NRV, or inventory must be valued at the NRV. Inventory must be written down to the NRV. NRV, bracket the lower. Bracket what? The lower. So take notes. Now, so it means that in exams, when it happened that way, when it happened that the NRV is the lowest one, then we have to perform some necessary rituals or adjustments. Now, what are the rituals? What will be the accounting treatment? First, the right inventory is the 119,000. So it means that the inventory, you can also say that inventory must be written down by the difference, by what? 1,000. So that means this inventory must go down by what? 1,000 Ghana. That's the That's the implication. So you can include it here. Inventory must be what? Written down by what? So inventory must be written down by what? 1,000 Ghana cedis. Good. Now in a P&L, how do you treat it? In a P&L, if you have already calculated your cost of sales, if you have what? Already calculated your cost of sales, then add this 1,000 Ghana to the cost of sales. It's an expense. Anytime you have an asset there, and you know that the asset, the value that the inventory, the value, you are not going to get it, then you have to write it down to the value that you make. This we call it inventory written down. Inventory what? Written down. That means part of the inventory must be what? Clear off. That's 1,000 Ghana cedis. We call it implicit impairment. Inventory impaired, but we don't call it impairment. We call it what? Written down or write-off. Implicit. Good. So the treatment, what's the accounting treatment? So one, first, add it to cost of sales. Add it to what? Cost of sales. Now, if you are now going to calculate your cost of sales, then it will be like open inventory, so much, purchases, so much. Now, this closing inventory, you have to pick 119, but not what? But not the 120. So it means that if you are now going to calculate the cost of sales yourself, then include this right figure. Most of the exam questions for the publication, they've already calculated the cost of sales wrongly. So take note of that. They've already what? Calculated the cost of sales wrongly. So we have to what? Reverse it or adjust it. So if you are the one calculating the cost of sales yourself, then use what? 119. So you only subtract 119, but not what? The 120. But if they've already calculated the cost of sales, what do? You add it to the cost of your sales because an expense. Then two, you subtract it from where? The cost of the inventory on the financial position, cost of what? Inventory. In fact, this one, if you do that, it will return you back to what? The NRV. What are we doing? We are giving the accounting treatment of the write-off. How do you treat the inventory written down? So inventory written down. The accounting treatment of what? Inventory written down. One, add it to cost of sales. It's an expense. Two, subtract from the cost of what? Inventory on the balance sheet. Now the issue is that the cost of inventory, if I take 1,000 Ghana from this 120, it will return it back to what? The NRV. So in short, just take the NRV to the what? Or take the lowest value. Take the lowest value. So take the NRV to the financial position. Now, if it happens that the cost is the one which is lower, you do nothing. Do what? Nothing. Let's assume that here the cost is 118. If the cost is 118, once the cost is lower, I will record it as cost, not the NRV. And then I'll do nothing, no adjustment, because the cost has been recorded in the books. Cost will be recorded in the books already. NRV is an estimate, not actual. All these things are what? Estimates. These ones are actual. This is actual. And this has been recorded in a book. We record actual, don't record estimate. So these ones are yet to be recorded. Now it means that if they've already recorded this and it's the correct one, what do? I do nothing because they recorded the right figure. But that's why when here was what 120, they've recorded this 120, but supposed to be 119. That's why I have to do what some rituals to convert the 120 to what 119. I am done. Now let me treat one last topic for today. Then We are done with this section, and then you'll be fine. Now there's a topic that I have to let you know. Why is it that the NRV sometimes lower than what the cost of what uh, inventory? So why, or circumstances that may lead to what the NRV being lower than the cost? So when the NRV is what lower than the cost, what are the conditions or the circumstances when? So one, if the inventory is what damaged or out of date or slow moving, so out of date or obsolete, out of what date, out of date inventory or damaged inventory. Assuming that your car, your vehicle, I remember when there was an accident, a cement car or a cement truck with a full of cement got an accident. And now some of the cement got broken. Can you sell this cement? Definitely. The value that you generate from this cement will be lower because it's what damaged or out of date. So out of date or damaged. So damaged inventory. Damaged inventory. Good. Two, at what circumstances that will lead to what? A lower NRV. And it also talks about what? Management intention, or it's a strategy. What? Management what? Decision. So management decision. Management what? Decision. Management decision. Yes, they can decide to lower the selling price. Look at the competition between Coke and then Pepsi. Pepsi said still one city, still one Ghana city. And then Coke said, the Coke style of life. That's bro, that's great. If you know this, that means very simple. The Coke side of life. Now Coke said we will sell our own at 2 cedi, but go to some time, we said no, let's sell it at one Ghana city. So Coke sell their own at one Ghana city. And then they realized that no, this management decision, our NRV is lower. So what do? So they start increasing it. But they even increased like 3 times. And now they shoot it up to 2 cedis, 50 pesos, and now finally to what? 3 cedis. How do you get it? So it's a management decision. So Coke reduce it from 2 cedis to what? 1 cedi. Trying to compete successfully with what? Pepsi. And then it was unsuccessful. And then they have to ship it back. So they realized that the NRV was far below the cost. So now they have to ship it back again. So that is it. And then when the selling price also reduced, reduction in selling prices. Reduction in what? Selling price. Reduction in selling price. Can also cause that. Reduction in what? Selling price can also cause the NRV to be lower than. Also cause the NRV to be what? Lower than the cost. So I hope you get it very well. Good. What about errors in the purchasing or production? So mistakes can also be errors. In fact, incorrect of recording of data can also let you you have underestimate what your cost, or you have overestimate your cost. But the cost will be overestimated. Or errors in purchasing or production. So errors. I'll talk about what errors. errors. So that is it. So that is it. Or increase in cost. The cost of production has what? Increase or decrease in selling price. So that is it. On that note, we have what? Successfully finished the IAS 2. Now, what level is the disclosure requirement? Disclosure what? Requirement. What are you going to disclose? So disclose the accounting policy in measuring the inventory. That's the cost formula. So first of all, tell us what formula are you going to use, or which formula are you using to value your inventory. The total carrying amount, any inventory written down, and then the NRV. Yes. So you disclose all of these to us. Now, I'll give a trial work, and then next time when we meet, we are doing the question solving stage. That's the last stage. Please be part of that stage, and then you'll be fine. Now, there's a question here. So when you get the handout, try and then go through this. Example 1 will be yours, and then example 5. Example 5 is your trial. So kindly take a snapshot of this and then try it from example 5, 6. From example 5, 6, 7 going are yours. Example 5, 6, 7. I will solve them when we start the question solving stage. Then question 2 is here. So try them for me and then you'll be fine, especially tutorial question. This one is what? ICA what? 1999 question. So try it for me and then you'll be fine. Then, so basically that is the end of the game. So thank you very much for coming. Once again, my name is Fred. You can call me Targets. Kindly subscribe to the YouTube page and you can enroll with us for all your tuitions, and then other lecture material. Kindly subscribe for us and then you'll be fine. Okay. So kindly continue with the question solving phase and then be fine. Goodbye.